This is Bill Brewster. Welcome to Value After Hours. Jake, you want to tell us your topic for the week?
Hey, value nerds. My topic today is Dan Rasmussen's The Way the World Should Work.
Toby, what are you going to be talking about this week?
I'll be talking about the legendary Tweedy Brown and their semi-annual report, which just came out September 2019.
And I will be talking about a battle of longs and shorts in restoration hardware and what I think is a very interesting story.
Right after this.
Tobias Carlisle is the founder and principal of Acquires Funds. For regulatory reasons, he will not discuss any of the Acquires Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquires Funds or affiliates. For more information, visit acquiresfunds.com.
I just wanted to say something generally about Cliffs, and in the podcast format generally, right? We're chatting, and I think that there may be some things that come out that are not precise, and for that I apologize. I'll always try to be accurate, and then hopefully we'll have some cleanup items in the show notes if anything happens. So that would be my only comment. So, like, for instance, saying the wrong target on Cliffs is not the ideal way to have a discussion about it.
Did it change its name? It was Cleveland Cliffs, wasn't it?
Yeah, well,
Cliffs
it was
Natural
Cliffs
Resources.
Resources, and then Cleveland Cliffs.
I don't even know it had changed its name, but I know that ticker, CLF, Cleveland. What else do you need to know?
That's right. Well, look, at the end of the day, I think the story is more complicated, and they're using what he said was undervalued shares to make an acquisition, and I still think that it's an example of a tough business throwing up tough decisions. So I stand by the conversation, but apologize for any inaccuracies. I know we have some financial analysts listening to this, and I'm sure they were pulling their hair out. Some random resource investor and saying, "What are you talking about?"
I think you flatter yourself that anybody besides us is listening to it.
That's fair. Well, I was pulling my own hair out.
So who's buying the Curate debt? Because let's just recap that. What was the Curate story?
Well, I've been on this thing for a while about who is taking the credit risk and the duration for a lot of this paper that's being issued corporately. And I think that I think the answer has to be people that are speculating on interest rates and credit spreads. Because if you have long duration paper, the way the math can work is if you're right on the rates and the spreads compress a little, you can make a ton of money on the nominal value of your bonds increasing. Right, like if you look at the return on treasuries over the past year, especially the long-dated ones, it was really impressive. But that's not a cash flow buyer.
I saw somebody, I wish I could remember who said this because it was such a great line. Somebody said something like, people are now buying stocks for the yield and bonds for the capital appreciation.
Yeah.
Was that Gunlock?
Was it Gunlock? It was a great line anyway. I'll give it to him.
That was a depressing interview. I almost had to take a Valium or something after listening to Gunlock talk for 40 minutes.
But what about the 40%? The 40% prediction for a decline next year?
It's a well hedged prediction, isn't it?
That's the non-prediction prediction.
That's right.
The prediction you have when you're not having a prediction. It just sounds good, and then whatever happens, it doesn't. You can never get called on it. You just get to float it out there in the ether and not take any heat for it.
Well, yeah, and then when you're right, you just say, "See, I told you," and then when you're wrong, like you said, you just hedge it. But I did find what he was saying very interesting, but it was not the most uplifting conversation that I've ever heard in my life.
What made you so depressed?
Well, I think he's right on a lot of things.
But
what do you think about all the fourth turning talk? How do you feel about that stuff?
That's very zero hedge.
Yeah, it is a little.
Well, we all have kids, and I imagine nobody wants to live through actual real, like storm the Bastille type of turmoil, right? But do you think that that's what Gunlock was saying?
Let's see. I'll give it like a 3% probability, right? So
40% probability.
40% chance.
Yeah. No, but I think it's hard to look at politics these days and not see blowback. We'll see. What I get concerned about with the market at these levels is compounding becomes tough for new assets if you are a true, in my definition, sort of cash flow investor. So I was looking at some quality companies, and it looks like most of them are trading around a 2.5% to 3% free cash flow yield current. So what do their buybacks really get them if they're buying back their shares at a 33 times cash flow number, and then you're getting 3% out of the gate? Like, if you're young, how do you compound money? And that's where I get nervous about
become an Instagram influencer.
Well, that's right, or a podcaster.
A podcaster. There's big money in podcasts. Wow.
Yeah, we're gonna split an airhead when we go to Berkshire, right? Just carve it up into thirds.
How much are they these days?
I don't know. Probably more than we're making off this thing.
It's like $1.70 a day, split 3 ways. Before tax.
It's okay if we just live below our 40 cents a day means. We'll be fine over time.
I think that was like when I was a kid. That was how much you could sponsor a kid in the third world for 40 cents a day.
Now you can do it on a podcast. That's good.
I will say that I was probably the most bearish on our last week, right, with talking about all that debt stuff. And probably a part of my errors and omissions should be to give a little bit more context in that in the short to medium term, I don't like today's prices for hardly any assets. However, as far as humanity goes, especially even the United States, I'm incredibly bullish over a long period of time. I couldn't be more excited for what the world could look like. Just technology. I think maybe the most interesting thing is the bottom billion people on Earth. I think their lives are going to get dramatically better. They're going to catch up a lot. And that's, the being able for them to just go onto YouTube and figure out like how to program something that they need to fix in their little world, and not, like the ability to spread information. All these things are incredibly powerful, and I'm really bullish that the world will be a better place. But it might just all the asset holders who own the things today may not be the same ones as we go into the future, but the productive capability doesn't disappear. Just the claim checks are probably not correctly arranged at the moment.
That might be one of the best things that happens for humanity. I'm sorry for laughing just then. I was thinking about getting them all a podcast so they can get their 40 cents a day.
Yeah, that would be good.
I agree with you. I think that I'm in exactly the same boat. I think the future for humanity and the technological changes, that the innovations and the improvements to people's lives are so great, and the future is very, very bright. But I think everything's pretty expensive at the moment, so there might be a reckoning in the short to medium term, but the long term is much, much better than it is today.
Yeah, and it's that, to me, it's that quote of Benjamin Graham's that it's bear markets when stocks return to their rightful owners. I'm ready for that.
So why don't we kick off the topics? Bill, you want to take it away with Restoration Hardware, tickers RH.
Yeah, I think it's an interesting setup right now. When I say interesting, I'm not saying like, oh, go out buy the shares. That's not what I'm saying at all. But I had a bias against Restoration Hardware. My mom's an interior designer, and she has always told me from like day one or whatever about quality furniture and how all this other furniture is crap and it's all made in China and this and that. So I sort of inherently had a negative bias towards Restoration Hardware from a quality standpoint. So I read that the CEO is talking about we have no competition and we want to be like Louis Vuitton or Hermes or Apple. And I immediately have,
You scoffed.
That's right. Yeah, and like anybody that's scoffing does these days, I took to Twitter real quick and laid out why I thought that was silly.
It's been a roller coaster ride of emotions, you and Restoration Hardware.
That's right. I'm just drinking scotch on Saturday. It's been a roller coaster. So anyway, it's sort of an interesting process that I've gone through on it. And Adam Robinson has said on Tim Ferriss's podcast, and I think Shane Parrish is also, there's a lot of opportunity in things that make no sense and things that are blatantly obvious. And that's something that I've tried to sort of say, okay, well, I'm gonna learn a little bit from that. And I started to dig into the Restoration Hardware story, and it led me to this book, The Luxury Strategy, that Bluegrass had recommended a while ago. And the first time I picked it up, I was like, this thing is, whatever. But now that I sort of have a motivation to understand the words that are written on the pages, I'm seeing the book a lot differently. I'm seeing what the CEO is trying to do a lot differently.
What are they trying to do? What's the story?
So, they're trying to take Restoration Hardware and become luxury of furniture, or reposition the brand would be a better way to probably say it. So historically, they have had the middle of the mall, or less, I guess, emotional retail engagements would be the best way that I can say it. They have invested a ton of money in these like absolutely sick retail stores. The one in Chicago is incredible. It's a lot like what Starbucks did with the roasteries. And they're trying to do that to reposition the brand. They're going to put out a tangential, it sounds like it's a hotel. Now I think it might be more of a social club, where you can live the Restoration Hardware lifestyle, which again, I scoffed at first. But with typical luxury goods, you can wear a Louis Vuitton purse and everybody's like, there's a way to socially signal. With something like Restoration Hardware, you almost need a club in order to signal to the world that you deserve to go in, or you're sophisticated enough, because all your stuff's in your house and it doesn't have logos on it, right? So I think it could take a ton of capital. I don't know if it's going to work, but I think it's super interesting what's going on there. And since it's a financial podcast, and then I'll stop talking, you can't talk about this story without looking at how he basically LBO'd himself using convertible notes to retire just a ton of shares. So it's just one of those things that I was originally closed-minded to, took a stupid hot take to Twitter, and now I sort of see why both sides are interested. And Berkshire's long. I think it was Ted. I don't know, but it's an interesting peek into what somebody there saw. So it's been a good thing to study.
On the luxury scale, can we just talk about that a little bit? Because I used this expression in a podcast a little while ago, and I forget which book it comes from, but it was masstige, which is like mass prestige, and that's like a BMW. It's an expensive car. It's a really well-made car, but it's not like it's not a Rolls Royce, right? Rolls Royce is the pinnacle of luxury. BMW is something that you see pretty regularly on the road. So what is Restoration Hardware trying to be? Are they a BMW or are they a Rolls Royce?
Well, I don't think that they can become a Rolls Royce. I think that they could probably become closer to BMW. What is interesting, and the question that I think is a huge outstanding question, is a lot of the expansion that they've talked about on the last earnings call is going to come from Europe. Whether or not Europe accepts America's version of luxury furniture remains to be seen, because my perception of European luxury is it's very, very historical based, and not like, if I was European, I would scoff at the notion of American luxury. So to your point, I think it's a BMW, and I don't know if they're going to be able to export the brand. I think that's easier said than done.
How many Cadillacs do they sell in Europe?
I have no idea. But
do you know the answer to that?
Imagine.
I don't know, but I bet it's not a tremendous amount.
But you gave the example, Bill, of Polo, of Ralph Lauren, and did you say that was quite successful in Europe?
Yeah, I think Ralph's upper label products scaled well. I think he did a really, really good job at associating himself with sort of the best, the MAGA of American business, right? I mean, he was 1950s, 1960s images, very cultured, and Ralph, I think, is probably the best example of an American luxury lifestyle brand that's been exported. So can you do it in furniture is sort of the question.
Polo Ralph Lauren, it's kind of confected, right? Like he's made that up not that long ago, started out selling ties in department stores, and he's built this thing. It's kind of incredible. Like it gives you the impression of it being this like old East Coast money, which, funnily enough, they probably are now because it's been so successful. But it's kind of a brand new invention. It's only 50 years old.
Yeah, I mean, he did a great job steeping himself in that great American era. I saw his car collection in the Louvre. That's ballin'. Like, it was crazy. So I don't know. It's going to be interesting. It's going to take a lot of capital to do it right, but it'll be interesting to watch.
I got to ask this question: like, what's happened to it I don't know where they were. I mean, I'm familiar with restoration hardware. I don't think I've ever bought something, but I've gone in there and looked at this stuff, and I guess it's kind of Ralph Lauren-ish, Polo-ish. But you say that they're trying to go upmarket from there to become. So that, presumably that means you sell it more expensively. So what has happened to the consumer who previously was in that part of the market buying restoration hardware stuff? Have they just gone away?
I think that they want them to go away. I think in order to execute the strategy, you're not going to be able to be you're not going to be everything to everyone. Actually, I think that's where Ralph got into a lot of trouble with his brand extensions. Once you could get RLX and RL Sport and all that stuff, what it was to be Ralph Lauren got diluted. So I actually think that how this could work is margins could go way higher than people think that they're going to go, but your actual transactions come in a little bit, which requires a lower inventory base and a shrunk capital base and a higher return on your invested capital, which you're already seeing some of. But I think that's probably where the CEO is trying to take the brand.
And he wins if Bernard.
Is this a long of inequality?
Yeah, maybe. I think it could also be a long of citification continuing and jobs sort of continuing to be like the cities being I guess it's inequality, but I'm not sure that I would capture it quite exactly the same way.
That was kind of that was kind of what I was trying to ask. Like, has that just middle part that previously bought that stuff just gone away, and now you've got to buy flat pack furniture that you put together yourself, or you get this sort of ultra luxury end of the market, and there's nothing kind of in the middle because there's nobody in the middle.
Yeah, I guess like that's where my aversion to the whole idea came, is it's not ultra luxury, right? But it doesn't need to be. They just need to sort of create the perception of being a club that people have emotional engagement with, and that in and of itself can be some sort of mass luxury product. And I did not think of that.
To me, I think you hit on my problem is the whole signaling mechanism. And when it's a Tiffany box that she wants to show off, or when it's a fancy car, or even a clothing label with an R and an L on it, or a Coach bag, all those things are about status signaling, right? And I just don't think people have people over often enough to justify the price tag. I don't know. Maybe I'm projecting.
Maybe if you filled your house up with restoration hardware, you would.
Yeah, you're not the customer, dude. Get out of here.
Yeah, fair enough.
No, I think you're right. So that's why I think if you Google these new showrooms that they have, I mean, the Chicago store is incredible. But I think that they're going to need to have other social clubs around cities where you can signal that, right? Where you can say, almost like Soho House, if you guys are familiar with that. I've been to a couple Soho houses, not because I deserve to be, they would hate me, but because I have a couple artist friends. I feel cooler when I'm there. And it's really stupid. But
what is it for folks who don't know? It's like you go in LA. It's like if you're a director or an actor or something like that, you go there, right?
Yeah, they just hate finance and lawyers, I think. I don't know.
There's no way I'm getting in.
No, we are. They would shun us.
What about podcasters?
Oh, dude, we're creative types now.
There we go.
All right, I'm applying tomorrow.
And so
I make $1. I make 1/3 of $1.40 a day.
And so these guys win if Bernard Arnault decides that he wants to buy them because they've reached that level of ultra luxury that he's after.
Yeah, so this brings me to another conversation that we had when I was commenting about LVMH and the Tiffany transaction. And you asked, or you had commented that Bernard wants to elevate the brand. And I didn't fully understand how he could do that. Maybe there is something intrinsic in LVMH that understands how to execute luxury that Tiffany has lost. I mean, maybe that's the synergy. I don't know.
Let me give you a counterexample. So, J. Crew. So I used to love J. Crew, and I bought a lot of J. Crew, not recently, and not in the last decade probably. And now I go in there and I just think it's expensive, and I can probably get something comparable somewhere else. So I think they tried the same thing, right? They used to have bits that you could buy, pieces you could buy alongside expensive stuff, and now it's just all expensive stuff. And I don't think it's worked very well for them.
Yeah, I'm not familiar, but I do have a similar perception of the brand that you do. And I think if you look historically at brands trying to go upstream, it's not an easy endeavor. So we'll see.
Hey, Bill, can you explain a little bit the convertible debt? And we were kind of joking that it's sort of like the ultimate like play for today's environment.
Yeah, I can try to. I don't have all the numbers in front of me, but basically what they did was when the shorts were coming after them in with the knives out. Let's see what dates. 2020 they issued some. 2020 or no, this is when they expire. So I guess that they issued them around 2017, 2018, 2019, something like that. There's 0% interest convertible notes that I'm pretty sure they can be stock or cash settled. I think that one was just cash settled, but I haven't been able to really dig into the terms yet. But what they then did was they entered into a hedging transaction where they bought calls at the conversion price and then sold calls a lot higher. So basically, they just moved the conversion price of the stock up. So they took in, I don't know quite how much in debt, but it was a lot. I mean, I think they've retired like 60% of their shares over the last 3 years. So they took in money today, bearing 0% interest with the promise of settling in stock or cash in the future. And then they entered a hedging transaction to push the price up. Today you're probably going to look at dilution, but if you were a shareholder from back then, the dilution's a wash. Like, who cares?
Yeah,
well, it's not a wash. You're way ahead. I shouldn't say it that way.
I found it amazing. So you're at your 0% interest rates. All right, that's already kind of a anomaly in the world. And then these warrants, I think the strike was at like 125% or 120% of that day's price. So you basically were just showing, like, everyone could draw a straight line of what the stock had been doing and just had it keep going and be like, oh, I'm going to be in the money for these. This is great, right? It's like the ultimate momentum, like, sales job. I just found it to be fascinating. Either the guy's either like a genius or he's going to like totally torpedo it and it'll turn into a massive zero.
Yeah, it's smart financial engineering, isn't it? It's a clever structure anyway for raising money.
Yeah, it was super smart. And I think that the implied interest that the company ends up paying is 2.5%, right? If you just take the fees on the notes. And then the note holder, you're probably thinking, well, if this goes well, I get the equity. Or if it goes bad, at least I take over Restoration Hardware, right? I mean, you have a claim on the company. The bankers are thinking that they're going to get fees. It's an interesting transaction.
What's your topic, Jake?
Today, talking about Dan Rasmussen's recent, I guess you would say, email or article about the way the world should work. And what's really interesting about it is that, we kind of all understand this idea of like, okay, you have government bonds. They set a certain kind of floor, the risk-free rate. Above that is some corporate spread. And then above that is some equity risk premium. So as we're theoretically moving up the risk, we should be compensated more. So he looked at the data between the interest rates and the equity risk premium and then eventual 10-year returns from there and found no correlations at all as far as the interest rates starting. So basically, the equity risk premium didn't really correlate that much with the 10-year return. It really was more with the starting price. So we end up with the real takeaway that everyone needs to know. The punchline was that paying high prices for stocks simply because interest rates are low is not sound logic. Now, I know we've all heard our favorite, rich uncle tell us that if stocks stay low, or if interest rates stay low for longer, equities are on sale right now, right? What do you guys think about that? Like, those two things are diametrically opposed at this point.
The thing that Dan is talking about, I think that's known as the equity, as the Fed model, right? That equity risk premium, where you look at the yield on the equities over the yield on, say, the 10-year. And when that's in positive territory, that means stocks are undervalued and you can buy. And there have been various people that is a pervasive myth. People think that is the case. And I've seen, for a decade, I think I remember writing about this on Greenback. So that's how long ago it is and this might be like 2009. So, and I think it was Hussman at the time who said there's no relationship, or if you include the interest rate into the Fed model, that equity risk premium, all you do is you destroy the informational value of what you're looking at. The thing that is the driver of returns is purely the yield, which is the inversion of the multiple. So the lower the yield, the higher the multiple, and vice versa. And the better the returns you get from lower multiples and higher yields. And what interest rates are is irrelevant.
Yeah, so I actually followed up with Dan and asked him, I quoted the Buffett quote about, low rates and stocks are cheap. And he said that this low relative to what and cheap relative to what, which I thought was funny because he referenced that both in the EU and Japan, they have lower rates and lower valuations. So they should be even more of an obvious buy than the US if you're using that logic. Right now he did another research paper a while back that he talked about where he had 4 variables that explained a lot of the variance in EV to sales. And it was the net interest margin, dividends as a percentage of revenue, 2-year forward revenue growth rate, and then return on assets. So this came up because I asked him, well, not all equities created equally. Some, maybe the U.S. equity is better quality than these other places, right? Better return on assets, better capital allocation. Well, those 4 variables that he put together, he controlled for the differences between the U.S. and the other markets using these 4 variables that explained a decent amount of the variance. And he found that even with that, the U.S. is still trading at a 30% premium relative to the rest of the world. So I don't know if I would probably say his takeaway would be to get a little bit more international exposure. If you're listening in the U.S., maybe don't suffer home country bias too hard. And also that actually that U.S. Corporate debt is reasonably attractively priced compared to the rest of the world's corporate debt, which I thought was kind of interesting, given our talk last week about how so much of it is probably overrated and there's huge amounts of it and it's kind of scary. So
is that because the rest of the world has negative interest rates? Or
yeah,
a lot of the world has negative interest rates.
Right. The spread between the government bonds and the corporate bonds in the rest of the world is not as attractive as the U.S. version.
I think that's one of those. I think it's super interesting. Once again, data destroys a pervasive narrative, but that's one of those things. It just won't die. That Fed model it's called the Fed model. I think the Federal Reserve has at least 2 Fed governors ago. It was something, or Fed chairman ago. That was something that people were talking about quite regularly, about how attractive equities were. As it turns out, I think they were probably right. Like, equities have worked really well, but the data just seems to be the data is decisive, I think.
That's interesting because I would think that equity benefits from low rates as long as it can continue to recap its balance sheet and buy in the shares, right? Because your share shrinkage, if you're if come on, this is 2019. This is how we talk these days.
I know. Jeez. It's all financialization of the economy.
Well, but that should be in my feeling is that's how the math should work. But I may not be correct. The data may prove me wrong.
I agree with you that the story is so compelling. I mean, how could it be any other way? If you've only got a limited number of options to invest, you can go and get virtually nothing. You know, you must be investing in treasuries and so on at your real return must be negative at this point, right? Even if your nominal is minimal or nothing, your real return must be negative. Therefore, you must be able to you must look to get a real return somewhere, and really you can get it in. Well, looking back over the last 10 years, you have been able to get it pretty decisively in equity. How can that story be wrong? And yet the data always seems to show that it's not. I don't fully understand why there's a disconnect, because I find the narrative pretty compelling too.
Well, what about this? Is it a reversion to the mean of the interest rate? So what ends up happening is everyone believes the Fed model. They bid up the stocks to stupid levels, and then returns going forward from there are then crunched. And then if you have any return to normalized interest rates, which we have had over lots of cycles, like we just happen to not have had it recently. But maybe the thesis, if it's lower for longer, forever, which I'm a little bit skeptical about, but if that is your viewpoint of the world, then maybe the Fed model does hold some truth for you.
So the equity has the longest duration, and then anything else is a shorter duration bet than that. So,
other than Argentinian century bonds.
Well, they've experienced a little bit of mean reversion, I think, recently, haven't they?
Yeah.
Well, I was just doing a little bit of math, right? And I had said some quality companies that I was looking at are trading, call it a 2.5% free cash flow yield.
Cha-ching.
Yeah. So if you look at that as a spread, well, what if it goes to 2? Think about the price appreciation. If you think about it as a spread over rates and rates go up, I mean, if that goes to a 4% free cash flow yield, you're looking at a 38.5% drawdown. Earnings need to grow a lot in order to offset that drawdown. Now, over time, they could, but as an investor, you got to be willing to take that punch and remain convinced that you're still right on the business. And I have this general operating thesis that says that stock price drives narrative. So it'd be interested to see who actually has the conviction.
You're caught between the Scylla and the Charybdis there, right? There's a great article, I think it might have been, or a great note by James Montier. It was his first one, I think when he got to GMO, or one of the first ones he wrote when he got to GMO, talking about investing in the age of financial repression. And he said, you've only got 2 choices. Either you believe that interest rates are, and when we go into these very low interest rate environments, they tend to last for decades, 20, 30 years. So
where's the analog for that? Like, what's the reference class?
I can't remember specifically, but I think he might have been able to find the US through maybe through the 50s was very low interest rates through to until so 50s were the low, and then early 80s was the high, and then we're back to
a low of 5%.
No, I think that because after World War II, the US had a gigantic amount, comparable amount of debt, having fought a world war, as we do now, having not fought a world war. So you're much weaker now than you were then for no good reason. But he says that it takes such a long period of time. You have to kind of make this decision. Either you believe that it will stay very low for a long period of time and invest accordingly, which means equities are cheap, or you think that you are going to see some mean reversion in the not too distant future, in which case equities are expensive. Flip a coin. I've got no idea.
Well, I was talking to somebody yesterday. I own a little bit of Costco as a growth bond replacement. I don't like owning that stock here. It makes me terrified. That's why it's tiny, right? But part of the reason I have the allocation to it is I don't know where the heck rates are going, and if they don't go up for a while, it should perform fairly well for me. If they do, it's going to suck, and I better have some money that I can dollar cost average down.
Maybe that's the answer. You just got to have the portfolio that has both bets in it.
I guess as long as they're rational. I mean, you don't want to get too carried away with that because then you don't have a view, right? But I would rather own Costco equity than some of the bonds out there. So, I'm sure there will be a time when I'm, crying that you guys will say, remember when you said this? And I'll say, yeah, I do. But I don't know what the answer is. It's a very difficult thing to navigate, in my opinion.
So many places where mean reversion is this so much sand in the gears of it right now. I mean, profit margins abnormally high, interest rates crazy low, debt not really mattering, being able to refinance. Like there's none of these things are it's hard to imagine a world where eventually those things don't matter or mean revert. It's just like how long is your investment career?
I think we've reached a permanently high plateau.
Yes, thank you, Fisher.
So, shall we move on to my topic?
Please.
When I first started in investing, when I first started trying to concentrate on it, one of the original documents that I read was this one by Tweedy Brown, What Has Worked in Investing, not to be confused with Jim O'Shaughnessy's book. Theirs came out in 1992. Basically, it was a collection of every bit of price-to-book research, any bit of academic research that had been done. They turned them into charts. And so the reason I bring that up, they have a semi-annual report came out recently. They're talking about the fact that price-to-book has sort of broken down as a metric, but they went through and they said that the flow metrics have worked quite well, and particularly they said that the acquirer's multiple type metrics have worked really well. So that was kind of exciting. As far as I know I stole that name from someone else, but as far as I know, I'm the only person who kind of uses that right.
Yeah, no,
has Tweedy Brown read my stuff?
Win for you. Have to have, right? Where else would you come up with that? Like, it's not a common term other than from what I've seen from you.
Out of my mouth, yeah.
Did you write them and ask them for some recognition over here?
Nah, I'm happy. I'm happy for it to be out in the ether. I'm happy for it.
There you go.
Well, do you think that price to book is dead?
Yes.
No.
Good.
All right.
Let's do this.
Okay, good. So, do you want to go, Bill? Why is it broken?
Well,
or was it dead?
I think that if you had a metric that Tobin's Q is maybe a good example of something that I don't think is dead. If you could have like a price to Tobin's Q.
What's Tobin's Q for folks who are
replacement value, right?
It's
market value over replacement value.
Yeah, like an accounting value, basically, replacement cost.
Right. So to me, that makes a ton of sense. Why something like that would not be done or dead. Price to book is harder for a number of reasons. One, a lot of the really good companies have bought in so many shares that their book value is totally fake anyway. Like maybe price to tangible assets I could get behind a little bit more. But just book, I think book is so perverted now. And I think it was Jesse Livermore did a pretty good debunking of book and how inflation affects it over time. So I don't know. That wouldn't be where I would hang my... I'm sure it'll have like a 5-year run or something like that because everything that gets this hated eventually bounces back. But
it's only
I wouldn't invest according to it. I don't believe in it.
I saw Corey Hofstein over the weekend, and we were talking about price to book because Hofstein had this great thing where he said, it's got 80 years of data. Like, how many years of data do you need to show now that it doesn't work? And you need kind of a long run of data where it doesn't work. If you go back through the French data, which is free, you can see that when that data series first came out from like 26 to 41, I think is the period, price to book, the value got absolutely smashed to pieces, and it looked, funnily enough, a lot like it does now. And so there was nobody kind of criticizing it when it was working, right? Everybody was a believer when it was working. So when it stops working, then people come up with the narratives for why it doesn't work anymore. One of the things that I like out of OSAM, they did this more recent study where they looked at looking back at that 26 to 41 period, what was it about that period that caused book value to not work very well? And what they said at that time was that was the invention or the popularization of the motor car. And the significance of that is that you need to build out an enormous amount of infrastructure. You need roads that can handle cars, you need fuel stations, and so on and so on. And Chris Meredith, I think, wrote that one. I'm sorry if I get that wrong, but he would say that the modern equivalent of that is the internet. That you've built out this sort of infrastructure of the internet, whatever that means, really. I'm not entirely sure what that means, but I guess it's more than the internet. It's the web being built out, and so through these periods of disruption, it is the businesses that are capitalizing on that go ahead, and you don't see the mean reversion in some of these other companies that are left behind, which is why cheap companies on a price to book value basis seem to have not worked recently. How's that strike you?
Yeah, I think the argument for accounting decaying from price with like book value as a metric, the signal to noise is like in the disconnect between intrinsic value, I think is probably a fair statement, especially in the U.S. for more service-based or IP-driven, software companies. However, I look at the rest of the world, and if they're going to be catching up and they're building a lot of stuff similar to the U.S. or even better than we have now, why wouldn't it maybe work somewhere else where maybe they're not doing as much IP and they're actually just, building a building or some other things where that signal now comes back in and works?
Yeah, I could see. I would buy that. The other thing is bringing it back to Restoration Hardware, right? They have a lease-based model, so you're not going to capture all the actual capital that entity needs because it's placed it off the balance sheet on somebody else's. So I don't know, like it's basically just an intangibles company with some inventory now. So I guess in aggregate, the entity that's holding the assets, maybe I don't know how all the math would work on it, but it just seems to me that some of these really big winners are intangible in our economy, but in foreign economies that are more manufacturing based, I could buy price to book.
Well, here's my question. What drives a company to earn these sort of supernormal returns? Is it the mere fact that they're sort of asset-light businesses, or is it because they've kind of defeated competition? Because my view is that it doesn't matter. The kind of asset composition of your business shouldn't really matter. It's the only thing that matters is what you can, what your competition allows you to sell your product for. But that's I think at the moment it sort of all looks like it's asset-light compounders that are the only things that are kind of working. Whereas I think it's things that have got, for whatever reason, they've just been able to defeat competition either permanently or just in the short term.
I'm not as optimistic either on some of the actual returns of these companies. I think about I think they've actually accrued liabilities that aren't readily seen. So for instance, if you're Facebook and you allow everyone to publish everything and you get yourself into hot water, there's potential legal liabilities, there's potential government, intrusion, there's and you see, I think their profitability has come down now that they have to hire a bunch of fact checkers to sit and look at all the things that everyone's publishing. Whereas you didn't have to do that when it was all quick and dirty. No one, while society adjusts to these new technologies, I think some of the expenses start to come back in and push down these, even for the winner take all situations. I'm not as optimistic that it's just going to be printing money all day for these guys.
Yeah, I think some of that's right. And then I also, Toby, to your point, I think industry structures matter a lot, and supply constricted industries for whatever reason. Bruce Greenwald would say historically, look at industries that don't trade share often. You look at the outsized returns in beer and cigarettes historically. I think if you can combine consolidation and not a lot of share change, you can get some pretty outsized economic returns relative to what a book should tell you that it would generate. So I don't know.
So
sorry, the thing that I've been thinking a little bit, and this may be stupid because now we're 10 years away from the financial crisis, but one thing that like clicked for me, because I'm a quick thinker, it only took 9 years, is, coming out of the financial crisis, these companies that had access to capital, of course they were able to squash the competition for a while. So how many people are looking at these 10 years saying this is the future? And now we're sort of getting to the point where companies are getting recapped and you're getting real competitors, and sort of the competitive landscape is able to flourish again, rather than just like the scorched earth that the financial crisis had left for a while. I'm not sure, but it'll be something to watch.
Is it a function of accounting not keeping up with book value? And what would you change to make book value better?
I don't know. I've thought about this a lot, actually, and if every solution that I've come up with violates the conservatism kind of tenet of good accounting. So I'm not sure what you would change. I mean, what do you guys? What do all the what are the other two listeners that are out there? What do they think?
Well, since I'm one of them, I'll pitch in.
Okay.
I mean, I almost always capitalize advertising expenses if I'm looking at a business. And I think that there's got to be some level of R&D that you have to capitalize in some of these businesses too. The thing that gets really tough in these intangible businesses is, everybody says this land and expand stuff, right? Well, let's say I have a retail concept like Five Below that has really good economics on the units. They get a payback within a year. If I just threw out 5,000 of those all over the US and then shut them down as they didn't work, people would say that's an insane strategy. But if I just hire a super huge sales force and pay them a ton and hope to land and expand, it's forgiven these days. I'm sure there are reasons for that I'm not thinking of, but it's something that I think of. It's a tangent, I'm sorry, but I get ranty sometimes.
One thing I've thought about with as we have older infrastructure now compared to a lot of the rest of the world, because we just built it and we're using it. So you think about at the most simplest version of an old building that's on the balance sheet that's been amortized or depreciated down to zero, like that book value doesn't reflect that anymore. So, like there's a lot of places where that can happen, where we write down things but really there's still economic value there, but price to book wouldn't be capturing that as well, which is sort of going back to my argument about maybe internationally it still makes some sense, because if you're building all that infrastructure, it's probably carried on the books at closer to, at least it hasn't decayed like it has here if it's been sitting on the books for 50 years.
I think this is a good opportunity to segue to the question of the week, which comes in from Nico in South Africa. His question was about how you treat leases. Do you capitalize leases or what do you do?
I like that our other listener is in South Africa. Well, I guess we have three. We've got one in Guantanamo also, so we're going global. Yeah, I think you have to make some adjustment for leases. Now they're on the balance sheet, but I think you have to at least think about whether or not the management team is being reasonable with it. Historically, at least as it came to retail, you would capitalize them. You take rent times 8 would be sort of the shortcut to get to what a trued up version of the liability would be. So if you're looking at leverage, you do.
Why that multiple?
I don't know 100%. My best guess is that you're capitalizing your leases at a 12.5% cost of capital. Feels a little low or high to me from a cost of capital standpoint, but that's the only math that I could think of. Some listener, please feel free to tell me I'm an idiot on that, because I have been thinking about that. Generally, I think that it should probably be a higher multiple given the interest rate environment that you're capitalizing the rent at, but I could be wrong.
Do you guys have any sense of how much latitude management has on the reporting of these assets and liabilities now that it's been forced to come onto the books?
I don't know, but I just assume that they've got enormous latitude and they're gaming it as hard as they possibly can at the end of every quarter.
I assume the exact same thing.
And I think that it does create this opportunity to renegotiate, which will, renegotiate your rent a little bit, or find some creative way of pushing some of the the costs that are captured on the balance sheet back onto the lessor. Like, you find someone who's a private guy who doesn't have to file, so he doesn't care what the accounting treatment of it is. He just cares about sort of maximizing his return on it. So he'll do something that doesn't make a lot of financial sense for you, but makes for the filer, but does for him. I think it's becoming increasingly important that you go through the financial statements and figure out what the economic reality is.
That would be my recommendation too, is that all these things, I'm almost always hesitant to give any kind of prescription, because really for me, it's like, okay, I have to approach this as what would a business owner look at and want to know, and then work backwards from there. Because I'm not sure that the accounting now is always, it may be even getting further away from being helpful.
Well, ideally, what you'd want to know is how long are all the lease tenures, and what's your weighted average cost of capital, and then you DCF it, and you got to get your present value number. But you only get 5 years of leases in a 10K, right? So, it's all just sort of guesswork. So somehow they got to rent times 8, and that was convention. So,
that just that creates an opportunity if your weighted average cost of capital is not 12.5%. If it's lower than that, then you're incentivized to do something there. I have to think about what it is. But anytime there's a little arbitrage, anytime you know that everybody's doing one thing, you can do something else and make your company look a lot more attractive than it is.
Yeah, I'm certain that times 8 is wrong. I'm just also certain that if you're wrong while you're doing it, you're wrong with everyone else.
I think I've heard that before. I think 8 is the rule of thumb.
It is the rule of thumb. I'm not 100% about the math behind why.
I wonder if there's any kind of what is the average lease period? Is it 5 to 10 years?
I would have said 10 years.
Does that put you at 8 then?
Yeah.
I don't know. But you're not going to capitalize them all at today's dollars. I would need to do a lot of math that I am not going to do right now. I'll tell you one thing that I found sort of interesting about that paper that you had referenced, Toby. They had a write-up on Fox, and then I looked through the 4 funds, and it's a 0.9% position. I would argue that's what doesn't work in investing.
Doing all that work and then putting on a small position
in one fund. I think they're right. Take a bet.
But sometimes maybe it's just it's a new position. They're just scaling in. I don't know.
Possible. I'm just saying. Swing.
So since you've raised it, what's the Fox? What's their idea?
Oh, it's in traditional media, linear TV, right now, the fear is that the bundle is unraveling. I think that there's a reasonable case to be made that the bundle will eventually hit some sort of floor-ish. It'll fade for a while, but as single-family homes become a greater percentage of total subscribers, you would think that they churn less because they tend to have at least somebody in the house that wants to watch sports, and say that person's a kid. Well, sometimes their parents want to watch news, and whatever you think of their political bias, Fox has a great product for a fan base. So the probability that they're going to be able to keep their economics or increase their economics as a percentage of the bundle, or that the bundle becomes more expensive as sort of rabid users are the remaining subs, I think is at a minimum a reasonable conclusion. So it's an interesting entity. It's a play on live news and a secondary play on sports, which is where all the value is accruing.
It's an interesting transitional period because they are going to have to start, like anybody else, like ESPN or any of the other companies that were probably getting a bit of a premium by virtue of the fact that they were in the bundle. They're now going to have to compete on their own terms. They're probably going to have to create their own tile, which means they're going head to head with Netflix and everybody else. You got to look at what differentiates you. Like they've got lots of years of experience of creating shows and running shows. I don't see why that wouldn't be helpful in this environment. That'd be a good thing in this environment.
Well, yeah, and especially Fox. They get the way that bundle economics work, I mean, you cross-subsidize a lot. So if they had to go direct to consumer, I don't know what the economics of that business look like. So the bet I do think is somewhat the bundle stays together in some form. But that platform, I mean, Bill O'Reilly left, they didn't have a hiccup. Megyn Kelly left, they didn't have a hiccup. Glenn Beck left, they didn't have a hiccup. I mean, it's crazy how good they are at replacing the stars and not having the ratings fall. I would not have guessed that. I bet they could lose Hannity and they'd just replace him tomorrow.
Did they launch podcasts, those three? Have they all gone and got their own podcast?
No, they make real money, Toby.
That's kind of like if you go and maybe they go and set up a podcast, they get 1 million followers immediately, and then you can monetize that, and maybe you can replace your income with that.
Glenn Beck he's got his own sort of direct to consumer. I don't know if it's called Beck Nation or whatever, but he's got a thing. I don't think it's nearly as successful as he was on Fox.
Well, I think that's probably coming up on time. How do we normally close this thing off? We'll be around next week. See you then.
That's right. Yeah, indeed.
Send us your questions.
Yeah, that's right. That's right.
And any other comments, places where we screwed up, we'll try to address those on the errors and omissions section for next week. And consider this more of a dialogue that people drop into and then keep it going after.
Send the criticism to Jake, send the errors and omissions to Bill, and send all of your compliments to me.
Stay safe out there.